Good morning, traders. This is Brad Matheny. Today is the 27th of August. I'm coming to you live, trying to share with you the information you need to protect your assets and to grow your assets over the next 5 to 10 years as the markets enter a very volatile stage. I want to talk to you today primarily about what's taking place in the markets right now and why you need to change your thinking if you are primarily long this market. There are a number of factors that are coming into play, primarily global asset devaluation, revaluation, as well as extended unknowns and concerns related to the U.S. economy and the U.S. political spectrum. That is reflecting in a downward cycle phase, which has become very evident on my custom index charts. We are now breaking channels, moving into downward cycle phases, possibly 1 or 2 weeks away from moving into a downward cycle phase, which could last into October of 2024. That means that the opportunity for general market appreciation is likely ending. You need to now shift your thinking away from speculative trading with a upward bias into consolidating your assets into a protective stance, moving away from aggressive trading stances and moving into more of a consolidated phase for the next roughly 60 days, roughly till October 10th or 15th. The top that I warned about 5-6 months ago took place just recently as a blow-off top. We've seen a beautiful rally off of the late 2022 October lows. Now we're moving into a sideways trend, which will likely consolidate into the end of this year before a very late stage Christmas rally and move into, again, a secondary consolidation in April, May, June of 2024. So the cash flow index is moving downward, broken below this lower channel. Confirmation of this move would likely put us back into this 110, 120 area. That would reflect a further 11% decline or more in the U.S. stock market. Large cap index is stalling out, rolling downward, back up near these highs. Understand, folks, that this was an incredible reflation rally off of the post-COVID dump that we saw in 2022. We've now kind of exhausted that rally momentum. We're now in a move to the downside, which will likely revalue back in this 130, 135 area, looking for support, trying to find out if the market is going to move downward in an extended downward decline or find support moving into the election. I believe the 18 months or so prior to the election are going to be extremely volatile. And I believe we're going to see an unwinding phase, which reflects an 11 to 15% downside move over the next 12 months. Global assets are moving in this topping formation as well, rolling over. You can see here rolling downward potentially on confirmation. This is, again, the strength of the U.S. dollar and U.S. dollar-based assets is predominant in the market right now, yet the global devaluation that's taking place after all this spending, heading into an election cycle, while the global markets deal with their own credit crunch and economic crunch, is going to likely weigh on the markets in a downward cycle. Many analysts are coming out and saying that the U.S. markets will likely move higher. The U.S. markets will continue until something breaks. I think something's already broken, okay? I think we've already broken an upward cycle phase, a reflation phase after the 2022 collapse in the markets. I think that reflation phase was more speculative than anything else. I don't believe that we have regained any real strength in the economy after this big blow off top, and I believe further unwinding is necessary to establish a bottom. Therefore, I'm warning you right now, be prepared for a solid potential 8 to 12% downside move over the next 60 days. The fear index is moving higher, my proprietary fear index, almost at 8. The SPY is rolled downward. I believe the 437 level is going to be a very critical level over the next 2, 3, 4 weeks. And I believe that the sentiment index is now showing signs that this reflation bottom cycle has peaked and is starting to leg downward. So we're in the early legging downward stages here, kind of like this area back over in here. Before we actually reach the peak, we've kind of gotten into this sideways legging pattern. I believe we could see a pretty big downside move, possibly down to 395 to 404 on the SPY. Real estate hostility index is weakening a bit. Real estate is still very wonky. I'm going to get into that in a minute. It's like the real estate market has gone through a shock. And right now it's looking for trend. It's looking for direction. The markets are essentially staying very elevated as far as price levels, very, very hostile in terms of economic environment for actual buyers to be able to buy into the market. And the Fed is going to do what's necessary to try to tame inflation. The custom tech ratio index has moved decidedly downward off of this almost engulfing bearish pattern. The tech ratio index is down at 2013 levels, 2013-14 levels. We have a long way to go in technology before we regain any of this, okay? And in fact, I believe we're going to be consolidating even further as consumers pull away from discretionary spending. In fact, consumer discretionary sector is moving downward this week based on my analysis and my systems, indicating that consumers are continuing to pull away from the economy right now. Global markets are moving decidedly downward. You can see here with this red line, U.S. markets are holding up quite a bit. Still not broken below this red line yet. The global markets lead the U.S. markets almost always in a downtrend. Okay, almost always. You can see here they peaked out here above the U.S. markets and started to move downward, whereas the U.S. markets rallied a bit further and then moved downward in 2018. Whereas here, peaked out roughly the same time in COVID, little bit early, and started to move downward. Global markets here peaked out in basically early 2021, rolled into a downtrend in July, June, July, August 2021, and started to move decidedly downward before the U.S. markets reached a peak. Same thing is happening right here. Global markets are moving downward, indicating weakness. This will translate into forward global U.S. weakness, and we're basically looking at this downtrend right now as an early warning sign that unless this changes direction and continues to move downward, the U.S. markets are going to get drugged downward by another maybe 10, 11, 12, 15%. U.S. valuation trend index is weakening, about to break down into a new lower channel right here. Very hard to comprehend when you think about where the U.S. stock market is, rallying off of lows. The sentiment in the market is very strong to the upside. The reality is that the U.S. stock market valuation trend index could break the new lows, could move down into this lower channel, and that could mean a very strong downward price trend, almost like a flash crash. So what you're seeing in the SPY and the NASDAQ is very much like a smoke and mirror type of analysis. Underlying the market trends, we have a lot of weakness going on. U.S. leading index moving downward. Should have drawn a line on this chart coming across these levels. You can see we've broken this channel again, downward. We're moving into a new downward cycle phase. It could accelerate to the downward downside. This is, again, a very strong warning, ladies and gentlemen, that we are now not in that upward bias trend anymore. If you are still long the markets and still believing the markets are going to move decidedly higher, we need to see some change in my indexes to actually support this. Currently, it looks like the markets are moving in a downward cycle trend, a devaluation cycle trend, which I believe will last into October of 2023. The U.S. stock, real estate market, this is the data that we get from Realtor.com. You can see again that everything has kind of rallied back up in 2022, flatlined back down into this area, and is now really consolidating around a flatline area. This has created a big disruption in dynamic modeling. You can see here that we've moved in price trending and modeling in a big dynamic downward cycle. This is because the markets of the real estate market in the U.S. has moved into this kind of a shocking lack of inventory, lack of transaction, lack of dynamic with regards to the market price. Market price is typically moving slightly higher right now, but I don't believe that the conditions will provide for any real growth in the near future. And I believe we're going to be transitioning very quickly, possibly within the next 5 to 6 months, into a very strong downward cycle trend. Real estate price trends had moved downward slightly, then spiked a bit, and are now back down at flatline. The real estate price reduction activity is moderately to the downside. Real estate active listing counts is moving just slightly higher. Active listing counts are very, very negligible right now. In other words, there's not a lot of inventory on the market, and you can see here how everything is kind of flatline, hooking slightly to the upside. We'll see how this plays out. If the new listing counts start to really flood the market with foreclosures and price reductions, we could see a very dramatic change in the real estate market very quickly. So we're going to see how this plays out, folks. It's not the same market trend we had 2 years ago. The real estate heat rank took a big dip. This was a massive decline, like a shifting shock. I kind of look at this as like a car wreck. This is basically a car wreck that took place, and now the market's come back down into flatline, saying what next? Tightness index, markets tightened up considerably, which was again the train wreck. Inventory strength dropped considerably, starting to move back upward, and seller desperation, you can see here, moved quite a bit higher and then just dissipated completely. It was like all of a sudden the data went from seller desperation, we got to get rid of our homes, to nope, everything's going to be okay, look, the markets are fine, to oops, we got to get rid of our homes, to now we're moving back in the other direction. I think what we're seeing here, folks, is we're seeing the markets contract to such a degree that the actual data is skewing itself because there's not enough trend to indicate what is happening in the market. U.S. stock market chart consolidating near this level. I still believe this middle apex area is going to be critical. I believe we move back down to this area and we consolidate, maybe moving a bit further downward. We will see. This is really unprecedented where we're at with the market. So much money in the market, so much government spending, consumers trying to hold on through this entire chaotic event. And like I said, on one hand, you have people working and spending and going about their lives like there's no problem. On the other hand, you have probably 50-60% of the population struggling to make ends meet right now. We're going to see how this plays out, whether or not this is going to be a contraction phase or an expansion phase. Believe it or not, given what's gone on, given where we're at, headed into a presidential election cycle, I am betting that we are going to see a consolidated contraction phase, looking for a bottom before we see any real expansion. The custom valuation index is moving downward. You can see here, this is normal territory for the stock market. All of this was excess, blow off excess, whatever you want to call it, post-COVID. So we're moving now down into these lower channels, these consolidation channels. You can see it, a downward consolidation trend. You can see devaluation in the stock market, devaluation of assets, and I believe the foreign markets are going to potentially be a catalyst over the next 5 to 10 years as a real drag on global growth. So we'll see how that plays out as well. Volatility index is moving decidedly downward. We will see how this plays out. We are finding support right down here around 12.5, 13. We could find support here and attempt to move a little bit higher. So there is that in play if this support holds. If this support does not hold, which again, watch the 437 level on the SPY, we could be looking at a deeper decline, maybe 10, 11, 12%, and that could move us into a new phase of market trending that really no one is paying attention to right now. So there is your update. I'm trying to get you to be aware that signs are indicating of a downward cycle trend. We have downward devaluation. We have downward cycle trend in the U.S. stock market. We have downward leading indicators. We have downward U.S. valuation trends, which this really has me worried. Because if we break down here into new lows, if we come down into a new downward cycle phase, we could see a fairly extended downward trend. We really could. It's not that far away. We need to see some support hold up. We need to see this really try to find a base or a bottom before the end of the year and hold up. Otherwise, we could be looking at a very deep trend. And again, the global markets leading the U.S. markets to the downside is a pretty good indication that we're in a very solid devaluation cycle phase that most people are unaware of. So could the U.S. market continue to trend higher for another 2, 3, 4 weeks? Yep. I mean, it could happen, but depending on how quickly these global markets move to the downside and how this downward deflationary trend plays out, we could see a big change over the next 3 or 4 weeks. And again, a big change could reflect in a sharp spike in fear, could reflect in a 370 to 390 SPY price level, and could reflect in a market sentiment dropping 15 to 20%. And again, that would be a big move. You're talking about a 10 to 11% downside move in the SPY, maybe a bit further. You're talking maybe 20, 25% downside move in technology and innovation. You're talking about a pretty big consolidation phase if we do not find proper support over the next 4 to 5 weeks. So be aware, we are in a mixed market right now, struggling to try to find some support, and we need to figure out where it's coming next. Right now, I don't see it, except the 437 level is going to be critical, and then the 404 level right about here is going to be critical on the SPY. So pay attention. 437 is broken, then we're likely headed to 404, 405. 404, 405 gets broken, then we're likely headed somewhere into the 370s. 373, 374. And that's your warning. Do not get overly aggressive. Do not try to become a superhero in this market. Keeping your dry powder and your capital liquid is the way you're going to move this forward, and waiting for the next big trend, which in my opinion is going to set up around October 2023. All right, guys, that's it for now.